How to evaluate a subject to deal worth. Hey gang, this is Mike with my real estate dojo, and today I'm going to talk about how to evaluate a subject to deal because so many of you, my students, have asked me for it, so I'm going to do a video about it, the way I look at things. Now, first, let me define what a subject to is. A subject to deal is a real estate investment strategy that I teach, that I go out and I market and I find a motivated seller, and all I do is just take over their existing mortgage. Therefore, I don't have to get a loan from the bank, nor do I have to use my own money, nor do I need credit cards or hard money lending because the seller is highly motivated and they just become my own private bank, aka seller financing. Now that we know what the definition of a subject to is, Let's let me define how I evaluate a deal, especially if it's a subject to deal. But before I dive in, I want to break down the psychological aspects of the value of a deal. And then I'm going to get into the mathematic formulas because there's so much information online about mathematics, but not really the psychological aspects of evaluating a deal. Okay. So without any further delay, let's start. So basically, when I'm saying about evaluating a deal, I'm talking about the different type of exit strategies that exist, okay, out there um, in total. Because if I'm going to wholesale a deal, let's say, I have to know all the different ways that I can structure a deal that I can make it a win-win, not only for me, but my end uh, buyer. Okay, I'm not going to define what wholesaling is. There's a lot of information out there. But the way I evaluate deals on a psychological aspect is two things. One is the deal, because the deal itself will have limitations. And the other one is the exit strategy. And the exit strategy will depend on every individual or every type of investor out there. But I'm going to go run to many types of different investors out there so you can get an understanding of what types of buyers and how they think and whether their thinking processes are. So the very first thing on the exit strategy, it'll depend on the investor, is the skill set. What type of skill set does this seller, or I'm sorry, not seller, that investor may have, okay? The investor might be myself, or if I'm going to wholesale it, it might be someone else, and I'm going to get into that in a second, okay? The other things that, that run into my mind is how much time is this going to take before I can exit? Is this going to be something where, I fix and flip and it takes me 3 to 6 months? Or is this something that I'm going to be a landlord, I'm going to hold for 7, 10 year play? Or is this a wholesale deal, etc.? How much time is this required? Okay. Now I want to put another thing is confidence. And this idea is not talked about many places, but we might have the skill set, we may have the time, but we may not have the confidence in ourselves, and we may not do the deal. And we have to understand that there are other investors out there too. So when I'm trying to wholesale a deal to an investor, I'm looking at their confidence. Are they confident? Because if they're not confident, they might have all the other uh, exit strategy factors checked besides the confidence, which means that they're not going to do the deal. Okay. Same with myself. Sometimes I'm very confident and I'm willing to make a decision in 30 seconds or less. And other times in my life, I haven't been confident and it's taking me 3 months to make a decision. Okay. So what, as above, as below, as the saying goes. Okay. The next thing that I think about in an exit strategy is, again, this is the psychological aspect. I'm going to get into the mathematic formulas in a second, is how much money is required, okay? And that's very important, okay? How much money is required? The next on the exit strategy that I'm thinking is that, what kind of strategy do I need to use? In other words, how much education do I need to have to do this deal? Okay, because that varies on the deal. If I'm doing, for example, a having a realtor put her offer on the deal on the MLS, I don't have to have a lot of skill sets. If I'm marketing to the homeowners direct, like the way I do, I have to have a lot of different education. I have to learn how to, become a master marketer. I have to learn how to qualify sellers and filter them. I have to learn how to all the different ways to structure deals. If it's going to be a short sell, if it's going to be a loan mod, if it's going to be a subject to, if it's going to be a lease option, whatever the story is strategies, okay, and education. Do I need, or the person that I'm going to, wholesale the deal? Now, why am I thinking about all the psychological aspect is because that's going to determine the deal worth. It's just not the numbers. There's a lot of other stuff that's in play that's going to determine the deal worth. Not only for myself, if I was going to buy it, or if I was going to wholesale out to someone else. Okay. Now, now that we have that, we also need to make sure we talk about the deal limitations, okay? Because some deals will have limitations. Let me give you one limitation, like negative equity, okay? So now, before I explain, notice that a deal may have limitations like negative equity. However, if an investor is sophisticated, then they know how to structure deals and still make this work. But if an investor is not sophisticated, then that deal will have its limitations. One example is if a deal comes through and has negative equity, to an investor that their skill set is maybe a cash buyer and they don't have the strategy of, subject to, then that deal will be contingent on, okay, dependent on the deal limitation factor. But if the investor is more sophisticated and they have other strategies, they have better education, then they can still turn this negative equity deal into profits through, for example, a subject to, okay, and then cash out down the line when the house builds more equity if the cash, if the property cash flows. And I'm going to get into the mathematics in a little bit, so I don't want to dive in too deep, okay? But so it's very, very important, for you guys to understand and anyone to understand that a, a deal worth, it doesn't matter if it's a subject to or if it's a real estate, but whatever the deal is, okay, in this case, subject to, we have to understand that the deal limitation is only limited to the amount of black belt or white belt that investor is. The more green they are, the deal limitation plays a bigger factor. The more black belt, the more master they are, they mastered it, right? Deal limitation has less of a less factor, okay? For example, doesn't matter what kind of deal comes into my plate, if I'm highly motivated, then I can make this deal work, okay? I say highly motivated because there's a lot of deals come to me and I just, toss them away because I'm not a wholesaler. I don't like wholesaling. I'm a buy and hold guy, okay? But if I was highly motivated, then I would make all deals work because every deal that comes to me is going to work for me or for my team members. What I mean that if a deal comes in, which 98% of the times I can do the deal, doesn't matter what kind of strategy I use because I have so many different strategies, and that's what I teach you guys in my profit sharing. If you're interested in working together, you might want to go check it out at mrnofluff.com or join my academy. But having more strategies will help an investor crack more home runs and close more deals versus someone that doesn't. Now, let's get into the mathematics, the formulas of how to evaluate a deal. Not because we got the psychological aspect taken away. Let me get something to drink real quick. All right. Now, the very first thing that I look at in the math part of it, okay, of evaluating a deal is the loan type. Loan type. This is very, very important because in a subject to deal, I am taking over the seller's existing mortgage. So the way I evaluate a deal is if the on the loan type, if the loan is fixed, of course I'm gonna like it a lot more than if it's not. What does fixed mean? Fixed means that the borrower got a loan from the bank and it was a fixed interest rate for 15 years or 30 years, okay? So I'm gonna look at the loan type. Is this loan a fixed or is this loan an ARM or is this loan a hard money lending? Okay, is this loan a whatever, reverse mortgage, and so on? Because if it's a reverse mortgage, then I'm not going to do a subject to because it has no value to me. If it's a fixed, it has more value to me than if it's an ARM. Okay, because I like to hold these properties for long term, and build equity. But someone else is maybe going to do a fix and flip and buys a house subject to, may not care that the properties are armed. That's why I talked about the skill set up over here and the strategies over here, because every different type of investor will have different strategies and different skill sets. Okay, so one of the most important things I say for me when I look at a deal when it's a subject to is the loan type, because as a buy and hold guy, my primary focus is I'm looking for fixed and nothing else. I'm not looking for hard money. I'm not looking for reverse mortgages. I'm not looking for, some private bank. I'm just looking for, cookie cutter bank mortgage companies with fixed rates. Okay. Now, the other thing is number two is equity. Okay. Is this deal that I'm getting, am I getting equity? Okay. Now, if I'm getting equity, hallelujah. But if I'm not getting equity, it still may be a deal for me. It still will probably have value for me as long as I go through other checkpoints that I'm going to be sharing with you. So equity. Now, how do I determine equity? Okay. Right off the bat, let me give you the formula. If you're a cash investor, you already know it. Whatever the comps are on the property. So if let's say the comps, the CMA equals 100K. Then what I'll do is I multiply that by 60 cents, okay? 60 cents, all right? And whatever I get the answer is 60K. Then I subtract that minus repairs, okay? And then whatever I get as an answer, then what I do is, again, I'll subtract my assignment fee. If I want to make 10K, I put 10K in here, and then that's my offer max. All right, so let me rewrite it here because I ran out of room, guys. Okay, so whatever the comps are, let's say the house in this case is 100K, then I multiply it by 60%, all right, which is basically 60 cents, all right. Then I minus repairs cost. Right? And then in this repair cost, again, there's going to be closing costs, holding costs, both ends, not just one end, both ends, because when I buy in, when I sell, all that stuff, I'm not going to get into that too deep. Just a basic understanding is 60 cents on the dollar minus repairs, then minus my fee, assignment fee, all right, equals max offer. And and if I get a deal at that, then I know I have equity. But if I get a deal where, it's not 60 cents on the dollar, if I'm getting a deal where I'm getting at 90 cents on the dollar, then no, it doesn't have equity. So if I'm getting at 80 cents, it still doesn't have equity, okay? Because by the time I do the closing costs, stuff like that, which is about 10%, I'm having very little equity, and I don't consider it 10, 15% equity, okay, at all. I When I talk about equity, I'm talking about deep discount. Am I truly getting 40, 50% of equity? And those are the deals. Now, if the deal doesn't have equity, then that's not a big deal because there's multiple things that make a subject to deal worthwhile. Okay. So now let's go to the next thing, which is this is a very important thing, which is cash flow. All right. The other check factor is cash flow. What that means is that when I look at the seller's mortgage, let's say the mortgage is $1,000 and I pay PITI. And what that means is principal, interest, tax, and insurance. If the mortgage is $1,000, I need to look at the rents in the area and see what the rents go for. If the rents in the area go for $1,500 a month, then you know what? This sounds like a pretty good deal without going any further just on the cash flow only. But of course, I'm going to look at all the other factors. But right off the bat, this will be a positive check. Yes, it does provide a positive cash flow. Personally, I never buy deals that have negative equity at all. Okay. Now, again, that's me. But remember when we talk about the psychological, just because I don't buy houses that have negative equity, I know other business owners that they're making so much money that they're willing to buy properties that have negative equity to get a tax wash. Okay. So again, that's why I took the time to explain the psychological aspect, because I have to be able to put myself into all the other investors' mindsets to be able to determine the deal worth of it subject to, because the way I think and the way I see the world may not be the same as everyone else. And I understand that, and that's what I teach my students, ladies and gentlemen. Okay. So I look at the cash flow because it's very, very important. Excuse me. A lot of people ask me, Mike, what do you think the monthly cash flow should be? And I always say, first, I don't give financial advice, but for it will be dependent on every different investor out there. Some people just need $100 a month. Some people need $500 a month. Some people are not going to do a deal and get $1,000 a month. So it all depends on the individual and what their life situations are. Now, let's talk about the next checkpoint, that formula that helps me evaluate a subject to deal. It's very, very important, is that uh, the funding type. Now, the funding type is going to be very, very important because it's going to determine, okay, how much cash do I have to come to, okay? Uh, is this funding going to, is it my cash? Is it have to be on a credit card? Is it going to be on, friends and family raising money? Which I don't do any of these. I don't like any of these options. I only do deals of my own. Is it going to be on a, you know, bank loan, hard money? And all these things will determine the wordiness of a deal, because if I have to put it on a credit card, then I have to consider the credit card fees, and is this worth it? Okay, and not only for me, if I sell it to someone else, if someone I'm going to sell it to Bob the investor, and I know he's going to put it on his credit card, then I have to consider that into the equation, because I don't want to be wasting my time dealing with this dude. Okay, or maybe I want to waste my time dealing with it because it'll work for him. So I have to run through all these scenarios myself and look at this deal and say, okay, what type of funding is going to be required to get this deal done? Is it going to be someone's cash, or is it going to be like hard money, or do they have to raise money, or is it going to be debt? And I have to somehow, if I'm going to wholesale this deal, then I have to calculate that. If I'm going to keep that deal myself, I also got to calculate it myself also, to know, hey, is this deal worthy or not? Okay. Um, Now, the other thing that I always look at, another factor, so I add all these factors up when I do a deal, guys, okay, is location. Now, notice that, I didn't put location at the very top, because on a subject to deal, to me, the loan type and the funding type is very, very important, because, for example, one of the funding types that I forgot is a subject to deal, where the seller allows me to just take over their payments or seller financing. Okay, so the funding type becomes very, very crucial. If I have to use all my money, for example, if I have to buy a house that's worth $100,000, and I have to put 100,000 take it out of my savings and go buy this house, well, that's great. Even if I have a lot of equity, I'm still thinking about it because it's a risk. Now, if I don't have to use my money and the seller already has a mortgage, well, that's more favorable for me, because I still get to keep my 100K, and I'm using the seller's existing mortgage, or the seller's becoming my private bank, however you want to say it. It's the same thing. Okay. So the funding type is very, very important. And so that's why I didn't put locations at the very beginning, because there are other factors for me that are not more important than location. Because if I can get house that's not prime location, but in really good location, and I don't have to come up with the money, and the seller's going to become my private bank, then that has more value for me than getting a primary area where I have to get hard money, where I have to get into debt through a banker and etc. All right. Because when I do these deals, I always structure a non-recourse loan with the sellers versus if I went to a traditional bank, I wouldn't be able to do that. If you want to get more information about that, make sure you join my academy or make sure you join my profit sharing guys and we'll work together. All right. So location, let's go to location, is very important, but for me, it's not the most important thing. Now, I'll explain some reasons why it will become important. So when I'm looking at location, I'm looking at to see if the prices of the properties are going to go up. Are they going to appreciate over time, or are the prices coming down? Okay. Why would they come down? Maybe it's a war zone, right? Why would it come down? Maybe it's by, a toxic polluted plant or whatever, right? It's a flooded zone or whatever. So I'm looking at the location because as a buy and hold guy, I am only looking for properties that are going to go up. Now, I don't just buy because it's a great location. Okay, again, that's one of the lowest factors for me. I look at what type of loan is it? Is it a subject to? How much money I have to come to closing to, and how much I'm going to cash flow, and those things have a higher value for me than the location, guys. Okay, now the other things I look at in the location is this a high area demand, right? What does that mean? Do they have good school systems? Do they have good parks? Do they have good jobs around the area? Or is this a low demand area, where people are leaving, this is shrinking, or, it's in the BFE that, there's no jobs. I'm not going to just buy a deal because seller's going to become my private bank and it's in BFE, and there's no jobs there. There's no one who wants to live there. I don't care if they're going to give it to me for free and I just got to make the payments. I'm not going to do that because I got to make the payments. And I'm in the business of having renters make my payments versus me making payments. Okay. So location plays a part. It's very, very important. I'm sharing with you, but it's not my top thing because there's other factors that involve into making a decision to know what is a worthy subject to deals. Okay. Again, war zone versus, nice school systems, highly areas that have jobs versus places that don't have jobs. Homes are closer to the cities versus homes that are really far away. No one wants to live there. Okay. Now, number six, what I look at is how much money is behind, because this is a subject to deal. And sometimes the sellers are behind. Depends on what audience I'm focused on. If I'm focused on foreclosures, then the sellers are going to be behind. That's why they're in foreclosure. If I focus on divorces, then there's a chance they're not going to be behind. They're making their payments. If I focus on probate, then there's a good chance I have a lot of equity. So it just depends on my investor that I'm going to sell the deal to, or if I'm buying the deal, where am I marketing to? So the money that's behind, am I have to come up with just 3K? Or do I have to come up with 25K? And the 3 or 25K will include closing costs, paying the arrears, if there's any rehab that needs to be done, holding fees, yada yada yada, so on and so on, guys. Okay, because that's very important to me. You know, um, I might have a great, loan type, which is, hey, the seller's willing to subject to the deal for me. I might have a great loan, which is a fixed rate, right, instead of a mortgage, right? The area might be really nice, but maybe the seller wants me to come up with $25,000 because they're behind 12 months, and I'm thinking, do I want to come up with that much money, and and have the risk, you know, and so I think about all that stuff, right? Because there is a risk of buying houses subject to, right? There's the risk of what I call due on sell clause, DOS, right? DOS. There is a risk. It has never happened to me, but it can happen, right? Do I want to put 25K down and buy a house that I know that, the bank may call up the note? I know they're not in the positioning, I'm not in the best positioning, or would I prefer to get a house where I only have to put 3K down, all right? And again, I know banks are not, they just want their money. They're not in a situation where they're trying to take foreclosure because it costs them a lot of money for foreclosing, paying attorneys' fees, paying realtors, paying the holding, paying insurance taxes, etc. But still, it's a possibility, and I have to take it into consideration. Okay, and that's why I'm sharing with you guys and gang. So as you can see, there are many different factors that go into a deal. The first factor is the psychological aspect, okay? What type of skill set, how much time do I have the confidence, or the person I'm going to sell to, do they have the confidence? How much money is going to be required, okay? And the strategies, the person I'm going to sell it to, do they know lease options? Do they know landlording? Do they know, or are they only a one, fix and flipper only, or are they only a wholesaler only? So I have to understand that. And I also have to understand the deal limitation. For example, the house may need $25,000 worth of rehab, right? To a landlord, he's not going to deal with that. Maybe not want to deal with that, right? But to a fix and flipper, this is a dream deal. So to a fix and flipper, the deal limitations is not a limitations at all. To the landlord, that is a deal limitation. Okay, so understanding the deal limitation will have a cofactor will be dependent on the education, the person that I'm selling to, the investor that I'm selling to, or the investor that's thinking about the exit strategy and what the deal's worth, and the skill set they have. Okay, and then we also have to summarize it up. We also have to realize that there's different types of loan types that are important on the deal worth, how much equity is in the deal, cash flow. Am I making $100 a month? Am I making zero a month? Am I making negative equity? Because believe it or not, there's a lot of people buy homes that and get loans and hard money, and they have negative equity they got to pay every month. Uh, and what is the cash flow? And also funding type. Is this where I have to bring the money in? Do I have to get a bank loan? Do I have to get private money? Do I have to get hard loan? Is this a seller financing subject to? Because all of that is going to determine the value of a deal if I keep it for myself or if I'm going to wholesale it. And location is very, very important. We all hear that location, location. Is this a war zone versus a beautiful area with nice schools? And last but not least, how much money do I have to come to closing? I always say behind, but to closing. That includes all the closing costs, the renovation, the marketing to find a renter if I'm going to rent it out, if I'm going to wholesale it, the time or the marketing to find that wholesaler, etc. Guys, all that together will determine, okay, how to evaluate a subject to deal out there, guys. Guys, if you enjoyed this video, do me a favor, jab the like button. Let me know below what you thought about this video, and then share this message and subscribe. Thanks for watching. Don't forget about, if you need some help in real estate, check out my free book at mrnofluff.com or join me in coaching. Peace.